Understanding how the stock market works isn't just about knowing what a share is. It's about seeing the big picture and understanding the invisible gears turning in the background. In this chapter, we explore two essential ideas: stock market indices and how trades are executed from start to finish. A market index is a collection of selected stocks designed to track the performance of a specific segment of the market. Indices provide a snapshot of market trends and investor sentiment. Help investors track market performance. For example, the S&P 500 rose 1% today. Used as benchmarks to evaluate investment funds. Basis for index funds and ETFs, exchange-traded funds. S&P 500 as a 500 large U.S. companies, weighted by market cap. Dow Jones Industrial Average, USA, 30 large industrial companies price-weighted. FTSE 100, UK, top 100 companies on the London Stock Exchange. DAX, Germany, top 40 companies listed in Frankfurt. Nikkei, 225, Japan, 225 Japanese companies price-weighted. MSCI World EM track global and emerging markets. Market cap weighted, bigger companies have more influence. For example, S&P 500. Price weighted, companies with higher share prices weigh more. For example, Dow Jones. Equal weighted, all stocks have the same weight. To invest passively using ETFs, for example, SPY tracks the S&P 500. For diversification without picking individual stocks, to compare performance against a standard benchmark. Ever wondered what happens when you press buy on your trading app? Here's how a trade is executed. Market order, buy sell immediately at best available price. Limit order, buy sell at a specific price or better. Stop order, triggered only when price crosses a threshold. You place an order through your broker, for example, Interactive Brokers, Saxo. Broker routes it to a stock exchange, for example, NYSE, NASDAQ. A market maker or another investor matches your order. The trade is confirmed. This is execution. Once the trade is executed, the back end kicks in. Clearing ensures both buyer and seller have fulfilled their obligations. Settlement is the actual transfer of money and shares, typically T+2 days globally. In some markets like crypto or real-time FX, this can be instant, T+0. Depositories, for example DTCC in the US, Euroclear in Europe, handle settlement. Clearing houses reduce counterparty risk. Regulators ensure transparency and fairness. Today's markets are powered by speed and tech. Algorithms handle trade routing, high-frequency traders ensure liquidity, and global connectivity ensures investors in Dubai can buy stocks in New York in milliseconds. Market indices track groups of stocks and help investors monitor trends and invest passively. Indexes like the S&P 500, FTSE, and Nikkei represent major economies. Trades involve brokers, exchanges, market makers, and clearing systems. Understanding trade mechanics helps investors make smarter and more confident decisions. Next up in our final chapter, we'll look at common mistakes beginners make and how to get started safely and strategically.